It's 9 a.m. in Beijing and Shanghai, 10 a.m. in Tokyo. You're watching The China Show. I'm Avril Hong in Singapore.
And I'm David Ingles here in Hong Kong. Let's get to your top stories today. A gauge of global stocks hitting a 4-week high as Wall Street extends a rebound despite the U.S. economy contracting in the first quarter. You have Microsoft and also Meta jumping in late trade on better than expected guidance and sales. Right, now the Bank of Japan set to stand pat today for a second straight meeting, but it may lower growth forecasts on worries over the trade war. Now, China says the U.S. has been reaching out for tariff talks as President Trump repeats his assertion that a call with Xi Jinping will happen. Good morning and welcome to the show. First day of May. That means just about almost every corner of the Asia Pacific in terms of markets are shut today. You have a couple, of course. You have a Bank of Japan decision, which we'll get to in a moment. And certainly it is, I guess, an opportune time to take stock of where we are, given how far markets have retraced higher. In fact, a gauge of global stocks, excluding the United States, actually hit a record high, right? So that's how far we've come in price. Volatility has remained quite elevated as well. You look at some of the earnings that have come through. So good on the backward-looking data, not so much as far as forward-looking numbers are concerned. And I think the point we want to make here is we're coming off a GDP print, a contraction, that we'll get to that in a moment. Then we're moving into more hard data that might actually show things are starting to bite as far as the U.S. economy is concerned. It's not just the U.S. It's mainly a U.S. story. It's not solely a U.S. story. We talked about China, and some of the soft data there have also started to show a deterioration in sentiment right now. So where does it leave markets going into May, which is historically not a very strong month for equity markets? We'll talk about that in a moment. A look at some of the markets that are shut today. Of course, a market reaction as well here across U.S. futures as well. Just to mention, of course, some of the big moves we're seeing in the after-hour session. We'll get to that in a moment. 1% on S&P futures. So just don't be surprised if you get either thin or extremely almost no volumes across these equity markets today. Right. All that being said, decent session so far on price. U.S. futures 1.5% on NASDAQ. That's a Meta story. That's a Microsoft story in post-market trade. When you look at Japan, though, and just flip the page, please, as well. There's a Bank of Japan decision. I'll make this very simple. Nothing is expected today. In fact, swaps are pricing in virtually no change today. In fact, the pricing looking at future meetings have now been priced out given the uncertainty out there. Now, to what extent can the Bank of Japan actually talk about the guidance moving forward? When you look at the Japanese yen, for example, flip the page in FX markets, asset managers and speculators are now extremely bullish on the Japanese currency. Simply looking at positioning going into May, the most bullish positioning from speculators and asset managers combined in years. Right, 2s and 10s in the U.S., you have ISM data coming through, jobless claims, and of course the non-farm payrolls on Friday. You have Brent, and you also have gold prices as well coming through here on your screens very, very shortly. And I guess to underscore the point that bond markets have started to price in a slowdown, 2-year yield now at a 7-month low. And Avril, I think the other point we want to make here is bad news is starting to become good news as far as U.S. assets go.
Yeah, there seems to be a bit of a market put underway. The data is telling us that the U.S. economy contracted in the first quarter for the first time since 2022. Despite that, consumer spending advanced and a gauge of underlying demand in the economy was solid. It's the first snapshot of the ripple effects from President Trump's trade policy. Economists expect a near-term rebound in growth, but expect a pullback in demand and a tough backdrop for the rest of 2025 due to the higher duties.
Core GDP, and this is, you probably saw some numbers today. And I have to start off by saying that's Biden. That's not Trump, because we came in on January. This is the quarterly numbers. Let's give us a pass on the first month. We were sort of getting a little bit used to things.
But it's interesting, right? Maybe Trump doesn't really need a pass after all, David, because if you look at the U.S. economic contraction, it was a lot to do with that rush to imports. If you strip out the trade imbalances at an annualized rate, it actually grew at the fastest pace since 2021. That being said, if you look in terms of the economic surprises we've been seeing of late. The hard data looking okay, but the soft data, the surveys, that's where some of these question marks are swirling. It does make you wonder when all this deteriorating sentiment starts feeding into the hard data. And of course, we'll be looking to the jobs market for further clues on that, David.
Yeah, I think you have weekly jobless claims coming out in a couple of hours in the United States. And of course, going into the weekend, as you have, and the previous coming up here in the U.S. payrolls report, prior to 28, we're looking at an estimate median about 130 to 140,000. Unemployment rate expected to remain unchanged there. So yeah, I mean, context is certainly key when you look at the data, right? But if only a lot of parts of the market were as nuanced looking through the data. And really, when you look at what corporates are telling us, right, some are not even giving us guidance as much. But anyway, we can get to all of that in a moment. But certainly markets are starting to either look through this or are starting to expect some monetary policy support coming through in the not-so-distant future. We have some breaking news, Avril.
Yeah, I mean, you talk about the corporates, right? And the Journal is reporting that the Tesla board opened a search for a CEO to succeed Elon Musk. And of course, there's been a lot of unhappiness and question marks about his involvement in the government with his role at Doge and the extent in which that is actually denting how he is looking at Tesla and the branding, the image around all that. So that's the word from Journal. We're getting Tesla board members reaching out to some executive search firms, potentially looking out for a CEO to succeed Elon Musk, Dave.
Well, speaking of reaching out here, let's get to the trade story right now and the latest on who said what and who is saying what and who is reaching out to who. The latest here, in fact, this might be the first time we're actually hearing from Chinese state media specifically talking about how the U.S. has been proactively reaching out to China through various channels, seeking to negotiate on these tariff issues. That's according to this social media post, that's a social media account, rather, affiliated with CCTV. That's a state broadcaster, of course. It's a post. It's in Mandarin, and Min Lo is here with us, our China correspondent, to help us translate that post and just give us a sense of what the message is there.
Yeah, so this looked like a very recent development because just yesterday at the 3 p.m. regular Foreign Ministry press conference, the Foreign Ministry spokesperson said that no talks has been happening. And then this post was posted sometime around midnight on a social media account affiliated with CCTV, essentially saying that the U.S. has been using various channels to reach out to China, and also saying that this shows that the U.S. is the anxious one and China doesn't have to negotiate unless the U.S. offers something pretty meaningful and substantial. And this offers us quite a different account of how things are going versus what Trump has been painting. He's been saying that China needs to be the one to reach out first. He thinks China needs to deal more, but it seems to be the other way around. And just earlier, Trump was speaking this morning saying that he thinks that a deal would be very likely, but any deal will have to be on U.S. terms. He hasn't refuted what we've seen from the Chinese state media. So interesting developments. But meantime, the big story on Chinese state media has been President Xi in Shanghai chairing this symposium for the next 5-year plan, 2026 to 2030. The main theme of his speech was all about managing China's own affairs well. So again, the attention was really on protecting China's economy against these external risks, less urgency on discussing these trade issues.
Yeah, although the external part, I guess, to be able to, I think, reshore support is what they're doing with the Europeans, right? And I think they have removed some of these sanctions on several European lawmakers. What's the background there, and what's prompting that?
So these sanctions were put in place in 2021 in retaliation to EU's accusations of China's human rights records. And when it was imposed, it essentially put on ice an ongoing discussion of an investment pact between EU and China that's been going on for 7 years. So this is a gesture of goodwill from China. It could potentially pave the way to both sides picking up discussions of that trade pact again. And this comes as we know EU officials have been looking at traveling to Beijing in July to visit and have talks with President Xi. It comes as the EU is considering price commitments from China when it comes to EVs as well, and China also delaying a probe into French cognac, delaying the conclusion of that probe by 3 months. Again, another gesture of goodwill, and it really shows how both sides are perhaps leaning towards each other as they find a way to counter or to protect their economies from Trump's tariffs.
Our China correspondent Min Lo for us there. Of course, we're seeing this warming up of China-EU relations. But the other big story we're tracking today, the Bank of Japan, is expected to hold interest rates for a second straight meeting today, with investors more focused on its quarterly economic outlook for clues on the impact of the trade war. And the Nikkei is reporting that growth forecasts will probably be revised lower. Let's bring in Taro Kimura from Bloomberg Economics in Tokyo. So, Taro, we see maybe some expecting a downward revision for growth, but what about inflation? Because the BOJ has been flagging these two-sided risks. We've seen the yen appreciating. How do you think they're going to play it when it comes to the CPI outlook, given how we've been seeing these hot prints of late?
Right. It's no surprise they're going to downgrade the growth forecast. However, I expect the Bank of Japan to keep their outlook around 2%, probably a sliver below 2% for fiscal 25 or 26, particularly the core measures because of the slowdown in surging food prices or whatsoever. But the core message with the new outlook for fiscal 27, probably kept around 2% as well, is the Bank of Japan is seeing the positive development in domestic inflation, and probably overshadowed by the tariff talks or chatters. But the latest Tokyo CPI data in April was a big surprise for economists. The core gauge outpaced 0.2 percentage point, and core 0.3 percentage point above the forecast. That means the Bank of Japan will be starting to get alert about the overshooting of the inflation, and at least there is a progress in underlying inflation picking up. That means, under their logic, the Bank of Japan has enough ground to edge up rates further. The main story is, of course, the tariff is a negative shock to Japan's economy, but at the same time, recent hot inflation print is because the inflation expectation is picking up with the domestic driver, which is the brisk wage growth revitalized for the first time in years, as well as the short supply of food such as vegetables and rices. So therefore, in the inflation ground, I think the BOJ will keep their stance girding for another rate hike.
Right. Taro Kimura, thank you so much from Bloomberg Economics over in Tokyo. And just a reminder, of course, Sharian, our colleague, will be live out of the Bank of Japan later, okay, to continue our coverage here of that rate decision coming through. Right. The other big story we're tracking, Ukraine, and Bloomberg has learned that the U.S. and Ukraine have reached a deal over access to war-torn, the nation's natural resources. Now, Kyiv hopes the agreement will secure President Trump's support in ceasefire talks with Russia. Let's bring in John Harney, our Bloomberg editor, to get us the latest here out of Washington. What do we know about this, John?
Well, this accord, which came after fraught, to say the least, negotiations, allows the United States to have access to natural resources and commodities in Ukraine, including graphite, aluminum, as well as natural gas. It establishes a reconstruction fund for Ukraine, but that will be managed by Ukraine as well as the United States, and the U.S. would have a claim on any profits that result from this fund. Now, as you point out, there was some relief in Kiev tonight after once this agreement was reached, because there had been fears not only among the Ukrainians but among other allies that the U.S. might just walk away from these talks here, intended to reach a ceasefire and an end to this war.
John, what is your sense overall of how Trump's tone towards Ukraine has softened?
I don't know if softened is quite the right term. It is certainly perhaps an evolution, maybe. Both Ukraine and the United States see this apparently as a sign of good faith on both sides. President Trump, of course, has been deeply skeptical of U.S. assistance to Ukraine that began before the Russian invasion that started more than 3 years ago, and he was particularly critical of President Vladimir Zelensky. But he seems to be quite pleased with this agreement, and he even said just a short while ago on a town hall that he brought this up and underscored the importance of that Ukraine signed this agreement with Zelensky when they met last weekend during Pope Francis's funeral at the Vatican.
John, thanks very much for sharing your insights and reporting on this. Bloomberg News editor John Harney. And coming up, we'll talk markets. Is the relief rally real or just a sugar high? Nomura CIO Gareth Nicholson joins us to talk market strategy. You're watching The China Show. This is Bloomberg.
Welcome back. You're watching The China Show. Here's a stat that you might have missed as you look at the rally on my right. The MSCI World Index, excluding the U.S., actually hit a record recently. What's behind that? Sugar rush? Or are we too hopeful here? Is that a relief rally in place? Gareth Nicholson is here with us, CIO and Head of Discretionary Portfolio Management at Nomura, to help us answer that question. Can I believe this rally, Gareth?
Well, David, it is a great technical rally. It's been driven on, maybe the market's moving too fast, some positive narrative around tariffs, but realistically, the two big fears in geopolitics, the two major stories is US and China really having real negotiations? And are we seeing, US, Ukraine, and Russia coming closer to the end? And I think there's a lot of uncertainty that, we could see a headline tomorrow from China highlighting that official talks are not underway, or we could see some action from Russia highlighting that the ceasefire or the negotiations there are still quite some way away. And a lot of this positive talk, this tariff negotiations that are happening around China in the Asia region, which is great, or some of the negotiations that are happening with US and Ukraine, which is also very positive, that could be unwound. So I think the market is very tactical. We're not seeing institutional players really move money in. We're seeing hedge funds being very active. And retail investors have really very much just stayed invested. They haven't really changed too much. So this is a market for investors to be very nimble. We think we're going to continue to see volatility. What we like is having a core position where we can sleep well at night knowing 60-70% is in things we like, but the other 30% we're very active with. So tricky market for investors.
Right. And Traditionally, defensive plays was, I would say, mainly, dollar positions. Dollar was down 4% in April, one of the worst months, I believe, in the last few years or so. How do I need to be thinking about how I should be positioning defensively?
Yeah, so the rotation trade out of the dollar has been a big theme that lots of people have got behind. We've been driving the idea that having a global mandate with 80-85% in US doesn't really make sense. You should be looking at other big economies. Japan is an economy, obviously, Nomura knows very well, focuses a lot on, and we believe the allocation should be a lot more than the 2-3% some global mandates have. So we definitely advocate moving out of a huge overweight to the US and looking more abroad. So that would include India, Japan, Europe. There's also sectors that we believe will continue to get support. And that rotation is very important. It's also not just geographical. It's also looking at asset class and predictable income. So we still like the predictable income from things like we think gold is still predictable. Private credit has some cracks, but we still think it is robust, particularly in the mid-markets. We like infrastructure. That is a big theme for many investors, and we continue to like that space. But it's building resilience by having a bit more diversified exposure. As we know, most of the predictable income has just come from tech, and that has grown up over the while. And now we think tech is a play that you're going to actually play the divergence within the big names. This is not a space where you go back to just holding, 7 names and let that create your income, your growth. This is about broadening out a little bit, talking to other experts in different parts of the market and making your portfolio a little bit more robust.
Gareth, it's BOJ Day. Talk to us about when you think is a good window for the central bank, and if they, start signaling hikes, how supportive that would be for the yen in breaking out, because it seems to be hitting a bit of resistance at the moment.
Okay, particularly for I think central banks is going to become far more important the second half of the year. We've actually pushed back our actual action from the BOJ and from the Fed to later on in 2025, early 2026. Our idea is the Fed is going to keep the optionality open whilst the economies are still doing relatively well, whilst we're seeing inflation ticking up healthily in Japan, but you've also got the potential of tariffs moving that too aggressively. The BOJ is going to keep their ammunition dry. We're most likely to get a hawkish tone coming out of the BOJ, which we think will be positive for the currency. We think this will also be relatively constructive for the equity market, showing that it's healthy inflation. And the idea that we're going to get one rate cut later on the year is probably still going to be conducive for a good environment for investing in Japan. For the Fed, we think it's slightly different messaging. They're going to also probably do one rate cut at the end of the year, but that's going to be allowing to see where the cracks are forming. So we think the cracks are forming. We think we're going to have inflation ticking up and growth ticking down, labor markets, potentially a weaker print coming out of non-farm payrolls. And this stagflationary environment, as it grows, we're going to see the Fed talk more about maintaining this risk, but not act just yet. We think they're going to wait until the end of the year, and then you'll really see quite a lot of action by December, January, February, March, going into 2026, where the Fed will be looking to secure up the economy, given the cracks are now starting to really show. So between now and then, not too much central bank coming to save the day. So it's really going to be on, what the geopolitics
Gareth?
are doing, how that changes, and that creates a lot of uncertainty.
Gareth Nicholson there at Nomura. Right, going into, there's no open today, so we'll get you guys an update, of course, of everything that's going on, plus this breaking news story out of the Journal on Tesla. Plenty more ahead. This is Bloomberg. Right, welcome back to Shows Here. Just a reminder that the majority of the Asia-Pacific markets are shut today, as you can see on your screen. So you have a couple of markets still, of course, online. You have Japan, Australia, New Zealand, U.S. futures, U.S. assets are still trading. We are, of course, going into BOJ, which should be out in the next 1 or 2 hours. Plenty more ahead. This is Bloomberg.
Welcome back. You're watching The China Show. Let's bring in Gareth Nicholson, CIO and Head of Discretionary Portfolio Management at Nomura. So, Gareth, we were talking about this earlier, right? When it looks like a tactical sort of trade as far as the U.S. rebound is concerned, we're assessing earnings. The tech names, what's come through so far doesn't look too bad. Given that, along with what we're seeing in the eco data, is it enough for you to make an assessment of whether U.S. exceptionalism has a shot at returning?
Well, Avril, the Magnificent Seven are magnificent. These are, fantastic companies that you look at the earnings, their quarter on quarter still, the top line is great. They're great companies, and they have a home in most portfolios. The only problem with it is our expectations of them have just got higher and higher and higher every time. And as Microsoft highlighted, the numbers were fantastic. They talked about their future guidance more like 5-10 years, what they're planning. But they were quite quiet when it came to the quarterly guidance. And investors are not maybe thinking correctly and a little bit too short term. And again, I think that drives from the narrative that we've become far more tactical given the uncertainty of the geopolitics. But we're likely to see, Microsoft and a lot of the big names increase volatility. They're going to have a few days where people are focusing on this part of the earnings, and then the next day, as we saw with Facebook, they talked about advertising revenues are looking good. But when you dive into the details, they're actually looking good everywhere outside of the US is where they're struggling, particularly in Asia. And this is why we saw some of the pullback. So I think the key message from the earnings is the companies do not have enough color to be able to say this is what we expect with conviction. This is coming across to investors. So we are trying to cling to whatever positive news we can. And as soon as we see a crack, is pulling back. This is not an environment where you buy and hold. This is an environment where you look for structures and other plays to be able to play into this optionality that the earnings are creating. So it is not an easy environment for us. Very much tactical. This is not a buy and hold and close the screens, come back after the holiday.
You talk about some of these cracks, right? When you assess the risks ahead, the potential for recession, although now it doesn't look like it, how do you, figure in the retail investor participation into this? Might that selling exacerbate any losses we see potentially down the road?
Yeah, well, I think for the US, that's the really interesting one. The retail investors, the non-institutional, they hold a huge amount of US equities. Their holdings have gone up from a 50% to a 60 to a 70. They've kind of come down only a small amount, whilst we were seeing other big shifts. You've seen a huge rotation out of hedge funds, fast money. Institutional investors have also started moving money, but the retail investors have not. They still have a large overweight. And if you had a long run, holding US equities has been a great trade. That inertia is definitely there. And that is a risk that if we see more cracks and this inertia changes and retail investors start selling, that is a tidal wave of flow. And in most economies, the real strength that institutional sees is when the locals are buying. India buying India is a great sign. When we start seeing China buying China again, that's going to be a great sign. US has been buying US for a long time. If we see any signs of cracks there, that's going to be a big warning sign. We're not seeing that yet, but the recessionary fears are coming. We're starting to hear more people talk about this topic, and this is going to be a key focus for allocators.
Right. Gareth, I'm looking at the VIX. Obviously we're not anywhere near lows pre-Liberation Day, but how would you be looking at the VIX right now as a leading indicator? Or is that also quite noisy and muddied at the moment?
Yeah, the VIX and the vol, this has become extremely important, particularly given that it's a strong indicator for leverage ETFs, a strong indicator for much more structured product ways of playing equity, and not just the outright mom and pop buying the S&P or buying a mutual fund. This is really important for the players on the buy side too that are hedging out of the risk. So we think this has become something that you watch on an intraday basis. It's a good indicator for very active trading. But for the longer term, to try see is it going to be above 30 for a long time, I think the volatility of volatility has just become a real difficult indicator for a long-term investor. This is much more of a trading indicator for us. So we don't watch vol as much when we think of longer-term asset allocation, particularly the VIX. There are other indicators of volatility that we would prefer to look at. Steepening of the curve, credit spreads, how some of the CDS have widened out. These are things that combined gives us a better indication of is it risk on or risk off. Purely just looking at VIX is a little bit messy.
Gareth, fantastic. Thank you so much for the time. Gareth Nicholson, their CIO, Head of Discretionary Portfolio Management at Nomura. Right, breaking news earlier on out of the Journal. So Elon Musk has been at the helm for nearly 17 years, and the Journal is reporting that could actually change. They've opened up a search for perhaps a new leader there for the company. Let's bring in Karen Lee, our Bloomberg Global Business Editor, joining us from Sydney right now to run us through what we know so far based on this report out of the Journal, Karen.
Yeah, well, David, you and I both know what big news this is, and it really can't be understated. Let's take a look at what's coming across the terminal right now. We're seeing that they've opened a search to replace Elon Musk. The board got serious about this about a month ago, according to the Journal, as the company's stock sank. But also, David, as investors were starting to get a bit worried about Tesla's image. with Musk's focus on his duties at the White House, working with Donald Trump on Doge. And board members, just looking at what they're saying, reached out to a number of executive search firms to work on a formal process to find that new CEO, according to people who spoke to the Journal. And this comes after tensions have really been on the rise at Tesla, and we've been talking about those quite a lot here at Bloomberg. Sales and profits have been falling very quickly since Trump took office and since Musk took on this new role. And Musk has been known to be spending a lot of his time in D.C. So the board members, according to the Journal, told Musk to spend more time on Tesla. They said he needed to say so publicly, but he didn't push back. So here we are.
So Karen, what would a change like this mean for Tesla?
Well, obviously, it would be huge. And I mean, let's look at Musk's involvement with the company. Like, his involvement with Doge has tarnished the brand for some buyers. Teslas have become this kind of symbol of resistance in the U.S. We've all seen that those photos and those videos of Teslas on fire. But Musk has run this company for almost 2 decades. And he's been deeply involved in all of his businesses, even those in which other executives handle that day-to-day management. So a change at the top would be big. It could be something where Tesla's trying to maybe disengage from Musk, rebrand itself a little bit away from that image that's come to define it in the past few months. But this would be a huge first step to that, and it would really be a new direction for the company.
It would be a mammoth moment indeed, Karen. We'll watch for more developments on that front. Bloomberg's global business editor, Karen Lee, for us in Sydney. Thanks so much. And we're also in the thick of earnings season in China. Here's the latest for you. Yum China reported weaker than expected operating profit last quarter as promotions aimed at frugal diners pressured margins. Operating profit came in at around $400 million, lagging estimates. Revenue was up less than 1% to about $3 billion. Also a miss. Yum China's US-listed stocks fell the most in the month post-earnings. The miss comes amid discounts induced by a fierce fast food value war in China. Meantime, Prada saw better than expected sales for the start of the year, bucking the weakness across the wider luxury sector. Net revenue for the group rose 13% at constant currencies, just beating the street. Retail sales at Miu Miu also grew 60% from a year ago. Prada saw growth across all regions, led by the Middle East and Japan. Dave?
Right. Now, speaking of earnings, HKEX, the operator of the exchange here, of course, in Hong Kong, reported record earnings in the first quarter. The CEO, Bonnie Chan, says she is expecting the IPO boom to continue, despite, of course, all this craziness we're seeing in this market. She also told us exclusively that the exchange is weighing not just dozens, in fact, over 150-plus applications to list, plus, of course, all the secondary listings that have come through so far. Have a listen to our conversation with her.
We have about slightly over 150 applications being processed, which is a very high number, I would say. But I see 2 big trends emerging. The first one is the fact that a lot of companies which are already listed in the domestic Asia market, they're now looking to also pursue an additional listing in Hong Kong. There are a lot of reasons behind that, but one big advantage of having an offshore listing status is that, therefore, it will give them a fundraising platform, and that could support their expansion plan overseas. You know, many companies in China are pursuing what is called the +1 strategy. So I think that's a big attraction to them. So in the pipeline, we have probably over 20 of those companies which have already filed, and another 20 plus which have already announced their plans to pursue an additional H-share listing.
Now, I need to ask you about short term.
Yeah.
The last few weeks has been extremely volatile for markets. And I'm wondering, just a general consensus based on the people that you speak with, are people more conscious or cognizant over pushing back pipelines for listing over the short term because of what's going on? Is there a sense that people are just waiting for the dust to settle?
Yeah. Well, first of all, I think the volatility is felt around the world. It's not specific to Hong Kong. But I would say even with all that volatility, and they are pretty dramatic, our market has demonstrated a lot of resilience. In fact, there was, this day when we experienced, quite a big correction. It was also the day that we've recorded record trading volume, and it was only a couple of weeks ago. However, I think probably a less noticed fact is that even amidst all this volatility, deals get done. We have in the past few weeks priced and successfully listed another handful of companies on our exchange, and the pipeline continues to build. So no signs of the appetite abating. In fact, quite the opposite. I think, given that we've demonstrated that resilience and we were able to trade through this period of heightened volatility in a very orderly manner, I think people are now beginning to really appreciate what Hong Kong and HKEX have to offer as a fundraising and a trading platform.
There we go. That was Bonnie Chan, the CEO of HKEX, speaking to us. Well, speaking to me exclusively. There we go. I'm going to take that. Why not? Anyway, if you're one of our Bloomberg clients, you can check that interview out. You can scroll back for that version. It's a longer run, of course, that we run there as well. We're in the thick of earnings season. To check that out on TV Go for our Bloomberg clients. And of course, if you have any questions for our other guests coming up here in shows, do send it our way. You know how to reach us. TV Go. This is the China Show.
Higher costs we expect to incur for infrastructure hardware this year really comes from, suppliers who source from countries around the world. And there's just a lot of uncertainty around this given the ongoing trade discussion. We're also working on, on our end on mitigations by optimizing our supply chain. And our outlook is really trying to reflect our best understanding of the potential impact.
Meta CFO Susan Li talking about the uncertainty over its hardware investments amid the US-China trade war. Despite the trade tensions, though, the big US tech firms have been investing heavily in data centers to meet rising demand for AI services. And of course, Asia has become a hotspot for data center construction. So let's bring in Pamela Ambler, APAC Investor Intelligence Head at JLL. Great to have you in the studio with us on a public holiday, Pamela.
Thanks for having me, Avril.
So what is your sense? I mean, you were just talking about this during the break, right? The tariff uncertainties, that doesn't seem to be impacting at all the data center demand that we're seeing.
Well, literally what you had just described in the story before was the investment from the tech companies, right? That demand exists, and one of the reasons why you're seeing that demand coming to Southeast Asia, there is a growing number of economies that are still increasing their digital adaptation. Digital transformation is a very big part of infrastructure development for a lot of nations, which now is more important than ever before, with data security being very front of mind. And that data center, a lot of that development is happening in this part of the world, in markets specifically in Southeast Asia, where you can get electricity cheaper than in other mature markets.
So then the question becomes, how do you enhance that ecosystem via financing? What are the tools that are being used there? What are you seeing? Is it easy, very easy to fundraise at this point?
Well, traditionally, there's been a lot of interest from investors, from banks, from real estate funds, now infrastructure funds, depending on who you're speaking to. Some consider it a real estate investment, others consider it infrastructure. So now you're talking about expanding that pool. And during times of uncertainty, there's oftentimes private creditors that also step in to provide financial support as well. Now, one of the things that, in addition to needing to meet the demand and capacity, is the fact that there are renewable energy sources that can grow, because for a very long time, what was holding back the development of data centers is the fact that you cannot secure the power before going in to build.
Right, so the resources as part of the ecosystem. But I was just wondering as well, what are you hearing from clients? Because since the emergence of DeepSeek, there's been a lot of reassessment of the exact amount of computing power that is required. Are clients concerned about maybe how that might curtail data center demand at all?
Yeah, that absolutely, it is a concern. However, when you think about the AI and the demand, what the DeepSeek has created is the ability to decentralize and allow more people to develop. You're essentially removing a barrier that existed and opening it up to more players. Before, it was very concentrated amongst a few big ones. And when it comes to the design of data centers, that's of course a consideration. And the need for the data center to be much more modern, have better cooling systems in order to meet that capacity. That is one area where we certainly have deep insights on in terms of advising investors to basically be able to future-proof an asset. The other aspect of it, I would say, is when you look at the broader renewable renewable energy demand, that also provides, again, the capacity that might be needed but could not be built prior.
Pamela, David here, and I wanted to ask you, I think you make an interesting point here in terms of the new structures of financing that have emerged to, allow big ticket items and more investors to participate in this. I can think of, I think power plants is a good example of how, creative financing was able to really get that rolling. If you could talk a little bit more about what you've seen in terms of the evolution of financial structures here to be able to allow more participation in these deals.
Yeah, well, beyond just the fundraising aspect where we're seeing funds being raised, in the past it might be a diversified fund where they would allocate a certain amount and deploy into data centers. Now there's increasingly data center dedicated funds that are being raised. You also see places where there are publicly listed REITs, and these REITs are able to gain scale because they have operators, they have an operating platform, they have assets. It's much faster and easier to scale. And then when you have these larger platforms, you have to bring in and consider bringing in joint venture partnerships. You consider financing and structuring your debt in a more sophisticated way, having the full stack of equity, mezzanine, all of that is available to do from a private credit standpoint.
And do we already have enough, let's say historical data? I would imagine it's not as extensive in terms of just simply data centers to be able to figure out what returns or stable returns are there for investors. What kind of yields are we talking here?
Yeah, well, yields, generally speaking, are for data centers are higher than the traditional asset classes, including office in most cases. That is the reason why investors are attracted to that asset class. And in particular, during times when everybody is looking for safe haven, if you're thinking about investing in real estate, data centers as the real asset, you're thinking about having a more stable, steady stream of income, which is more defensive during times when people are looking for safe havens. And the other thing to add to that is the tenancy agreements tend to be much longer than they are compared to some of the other asset classes.
Pam, would you be able to put some sort of numbers to the data center growth that we're seeing or expecting this year and the next?
Every market is very different. We do see the largest amount of growth happening in markets like India, Japan, Korea. These markets, not only do they have existing capacity, but they are also experiencing conversions of older assets. They have power sources beyond just electricity. While electricity is prohibitively high in a market like Japan, for example, there are also nuclear plants that have been mothballed. We're also talking about things like solar, onshore, offshore wind, battery storage that can all support the infrastructure that is needed.
Certainly something we'll be keeping a watch on. Thanks for coming in and talking through all these opportunities and what investors are really keeping watch on amid these data center demands. Pamela Ambler, thanks so much. APAC Investor Intelligence Head at JLL. Plenty more ahead. This is Bloomberg. Welcome back. You're watching The China Show. Here are some of the big corporate stories we're following. Microsoft shares jumped after the bell on reported stronger than expected quarterly sales and profit growth fueled by high demand for its cloud services. The company's third quarter revenue increased 13% to $70 billion. Microsoft's cloud unit, Azure, posted a 33% revenue gain in the quarter, with 16 percentage points of its growth attributed to AI. Meantime, Meta also posted quarterly earnings that defied tariff concerns, with $42.3 billion in sales beating estimates. Meta has adjusted its forecast. It now expects to spend up to $72 billion this year, with a focus on advertising and AI. The company says AI is helping improve its ad business, which still makes up about 98% of its revenue.
Yeah, and really, just to continue that strand of, data centers, you had tech earnings that Avril just laid out. We just talked about the Asia-Pacific opportunities there, and, how the news gods have really coalesced to give us this right now. So, this is a story that we've been tracking for, several weeks now. So Spark New Zealand, up as much as, I think, 1.5%, give or take, and has now confirmed that it was looking for partners for its data center portfolio. And as you can see, related stocks are on the way up there. We are, of course, entering the next hour of the China Show, and we are likely, if not almost certainly, going to get the Bank of Japan decision coming through in the next hour or so. Yen crosses on your screens on holds as we approach that BOJ decision, and we're expecting them to stay pat for a second straight meeting. Welcome back. You're watching The China Show. Chinese markets are closed today, as with many markets in the region. And I blame the BOJ for placing this meeting on this specific day. Otherwise, we would be off enjoying things at the beach, maybe half asleep at the bar, maybe in bed. But anyway, it's BOJ Day. So, and by the way, there's lots to talk about as well, right? And Meta earnings have really come out for us to talk about this AI story, this pullback we're seeing in the sort of risk premium in this market, the data that has come out to the U.S., GDP contraction, you have the weekly jobless claims coming through. What will the ISM numbers look like today? And really, when we get a weak number there, if we get a weak number there, that's going to be both China and the U.S. Soft data for both protagonists in this trade war have seen their respective soft data points start to deteriorate going into hard data season. U.S. jobless, U.S. non-farm payrolls, of course, are coming out. And of this week, we're looking ahead to that. In the meantime, though, what will the BOJ say? What can they say, given the clouded outlook right now? Some reporting, of course, out of the Nikkei that we might see a sort of pullback in growth projections. Watch out for that. Very quickly, let's please have a look at your sort of twos and tens as well. Gold, and also where you are with Brent prices. Oh, we just pivot back to the same board. Anyway, there we go. That's what we're looking at on your screens. Global stocks for your high MSCI all country. MSCI World, excluding the U.S., record high in the last few hours or so. Gold has been pulling back from highs, down about 5%. On the very point we were making, that are markets too complacent, or can we trust the momentum that's come through going into historically what's generally not really a good month for equity markets? But it's been anything but normal when you look at April. Let's bring in Sherry on, our Asia Trade Co-anchor, of course. She's been roughing it in the mean streets of Tokyo outside the Bank of Japan to get us up to speed on what to expect today, Sherry.
I gotta say, despite the fact that we do have to be working because of this Bank of Japan policy decision, it's a beautiful day out here. When it comes to the actual content today, we might not get much when it comes to that rate decision. The expectation from all the economists surveyed by Bloomberg is that there will be no change for a second straight meeting with the rate at 0.5%. But of course, it's what comes ahead that we'll be watching, right? Especially the quarterly economic projections. Now, the Bank of Japan has maintained that they'll be able to achieve the price target by the second half of their 3-year outlook through 2027. We'll see what the wording on that becomes, especially what the inflation expectations are. Remember, despite the fact that Governor Ueda has consistently signaled that he'll be awaiting the outcome of this trade uncertainty, that they're really considering that carefully, we have seen inflation really accelerating in Japan. National core CPI topping 3% for the past 4 months. So inflation is hot. That will be something that Japan policymakers will be considering in today's rate decision, despite the fact that, of course, growth forecasts, David, as you mentioned earlier, the Nikkei saying that those forecasts might be downgraded because, of course, all of these trade uncertainties. That will also be a key part of what they factor in today's decision. And, of course, going ahead, could we see that first cut in July is what some economists are thinking. Bloomberg Economics expects 2 more after that by the end of 2026.
And of course, Sherry, we've been seeing this yen appreciation of late. How might the currency perhaps figure into BOJ deliberations?
That gives them a little bit more leeway, right? Remember the weakness of the Japanese yen, the cost of living surging here in Japan has been a key factor why the Bank of Japan actually included back in July that line about the yen is more likely to affect inflation than in the past. So will that line remain now that we have seen that yen appreciation that you mentioned, Avril? We are talking about a 10% gain or so against the U.S. dollar year to date already. So how will they factor in a stronger Japanese yen together with higher bond yields as well? The ructions that we have seen in global bond markets, currency markets, all really being felt here in Japan. The wording around the bond purchases, that reduction that the Bank of Japan has been carrying out will be interesting during Governor Ueda's presser. Some economists saying that perhaps the yield reactions that we're seeing, especially in today's session where the front-end yields are still down because of the expectation that the BOJ will hold, that perhaps they're not necessarily pricing in the potential of more normalization to come later in the year.
Yeah, so we could see more flattening of the Japanese bond curve to come. Sherry Ann in Tokyo for us on such a beautiful day. We will have more analysis on the BOJ decision ahead. Monex Group Expert Director Jesper Koll joins us to discuss the BOJ's rate path and the outlook for the Japanese economy. David?
Yeah, let's, while we wait for that, and the BOJ, of course, just to mention that could come, in fact, any time now. Let's talk about Ukraine and the developments that we are seeing there. Bloomberg has learned, of course, that the U.S. and Ukraine have reached a deal over access to Kyiv's natural resources, really giving hope that the agreement will secure President Trump's support with ceasefire talks when it comes to the Russia part of the conversation. John Harney is with us, our Bloomberg editor, joining us from Washington right now to just get us up to speed, John, on what exactly do we know about the deal between the two here?
The accord provides access to the United States to various natural resources in Ukraine, including aluminum, graphite, as well as natural gas. It establishes a reconstruction fund for this country that's been ravaged by war for more than 3 years now. But this fund will be managed by both the U.S. and Ukraine. And the U.S. would have the first claim on any profits that result from it that could be, and I stress could be, used for any fresh military assistance. As you point out, this suggests a commitment by Donald Trump, President Donald Trump, to the peace process, the negotiations with Russia to bring about an end to the war.
Yeah, John, I was just going to ask, how does this potentially move the needle in the way that the U.S. is currently engaging with Russia, if at all?
Well, first of all, it means there's something it's seen as a show of good faith on the part of both Ukraine and the Trump administration. This comes after Donald Trump as a candidate and as president has expressed misgivings and skepticism about American assistance for Ukraine that began under the Biden administration, in great amounts during the Biden administration, especially after the invasion began. And he's been particularly critical, of course, Trump that is, of President Zelensky. And of course, that led to that culminated in the Oval Office blow-up between Zelensky, Trump, and Vice President J.D. Vance. At that point, a minerals deal was supposed to have been signed, and then it all sort of blew up along with that White House meeting. This agreement came about in a much quieter way here in Washington. There was no ceremony, no cameras, as far as we know, and that stands in marked contrast to the now infamous Oval Office session.
Yep, indeed, we've seen that shift in tone between Zelensky and Trump at the Vatican as well. John Harney, our Bloomberg news editor for us there, thank you so much. Now, plenty more ahead. This is Bloomberg.
Right, so welcome back. Let's get you the latest here on did one side call the other in terms of who's reaching out on this trade deal here. So you have Chinese state media now, and this is important, it's 10 a.m. local time, so it's about 8 hours back, so very early morning in the Asia hours here, saying that the U.S. has been proactively reaching out to China through various channels seeking to negotiate here on tariff issues. That's according to this post by a social media account at around that time affiliated with the state broadcaster CCTV. Min Min Lo, our China correspondent, is here to take us through the latest here and what we know so far based on the translation of this post here.
Yeah, so it's interesting because we actually haven't gotten any official announcements from any Chinese ministries, but this social media post is seen as pretty reliable given it is affiliated with state TV, state media. And it's citing sources saying that the U.S. has been reaching out through various channels, and it really shows us, it paints a different picture of what Trump has been saying, right? He's been saying that China needs to reach out first, that China needs to deal more. And this morning he says there is a strong likelihood that we could reach a deal soon, and he says any deal will have to be on U.S. terms, but that still remains to be seen. That social media post was saying that the fact that the U.S. is reaching out first, it shows that the U.S. is more anxious and that China doesn't actually need to negotiate unless the U.S. offers something more meaningful. So it remains to be seen because the U.S. has said they won't be offering any unilateral lowering of tariffs. So what is the U.S. going to offer? What would be enough to get both sides to come to the table? That's the big question. And of course, President Xi has been chairing this symposium as well in Shanghai, discussing the next 5-year plan from 2026 to 2030. And the big focus there was all about managing China's own affairs well. We know China has been, girding itself for a protracted tariff war. They are prepared to stay in this for the long haul and not in a big rush to try to negotiate with the U.S.
And meanwhile, this sort of de-risking from both sides, right? We have a story here that talks about how CIC, that's the sovereign fund in China, is starting to look at ways to divest some of its U.S. assets.
Yes, we have seen this actually not just with China. Some of the big endowment funds from U.S. universities like Harvard and Yale, they've been cutting exposure to U.S. assets. So the Chinese Sovereign Wealth Fund, we don't have, public data on how much exposure they have to private assets by country, but we understand from sources that it is looking to sell some of its alternative assets, such as assets in real estate, in infrastructure, as well as some private equity, selling as much as $1 billion in U.S. private equity. Not clear now what exactly is the target that they have in terms of reducing their exposure, and we know publicly, based on their annual report as of 2023, about U.S. makes up 60% of its holdings, of its public stock holdings, and it has about half of its holdings in alternative assets, and this certainly will put more pressure on U.S. assets, given the weak data we're seeing growth coming down in the U.S. as well.
Yeah, hard and soft data. Min, thank you so much. Min Lo, our China correspondent. And also when you look at sort of some of the earnings that have come through on the softer side. The opposite to that, though, is when you look at HKEX and what they reported yesterday, record profits, record revenue, record profits. The CEO, Bonnie Chan, says she is expecting the IPO boom here in Hong Kong to continue despite all the craziness taking place across these markets. Have a look.
We have about slightly over 150 applications being processed, which is a very high number, I would say. But I see two big trends emerging. The first one is the fact that a lot of companies which are already listed in the domestic Asia market, they're now looking to also pursue an additional listing in Hong Kong. There are a lot of reasons behind that, but one big advantage of having an offshore listing status is that, therefore, it will give them a fundraising platform, and that could support their expansion plan overseas. You know, many companies in China are pursuing what is called the +1 strategy. So I think that's a big attraction to them. So in the pipeline, we have probably over 20 of those companies which have already filed, and another 20 plus which have already announced their plans to pursue an additional H-share listing. So that's one thing that we've seen. And then I'm sure you have picked up the fact that there's a lot of talk about these Chinese concept stocks, which are listed in the overseas market, in the US in particular. They may be considering whether or not they want to pursue an additional listing, just to be prepared for, uncertain scenarios. And therefore, I would suggest that Hong Kong is a very attractive venue for that. In fact, we've received a lot of inbound inquiries. And so as we get further into the year, you may also see some applications in that regard.
So you mentioned about 150 or so active applications to list here in Hong Kong. Are any of those 150 plus Chinese companies listed only in the U.S. that might be looking for a plan B in Hong Kong?
Well, it's all public knowledge, so you can go through the list. But like I said, there are quite a number of companies we have been engaging with. They have expressed an interest to pursue a listing in Hong Kong, and we certainly welcome them.
I mean, the sense we get, and I think it's important to just underscore the point you're making, Hong Kong is open to anybody. And, the sense that we've gotten so far is, Chinese companies listed in the U.S. are looking for a plan B. Would the HKEX be open to American companies in case they wanted to raise money here in the city?
So, David, you're aware that we have been spending a lot of efforts, really, to make sure that we market ourselves not only to mainland Chinese companies in the mainland, but really all types of companies in every parts of the world, I would say. And in that regard, I've made endless trips to the US, to Europe, in the Middle East, and various ASEAN companies. And I would say that, we are beginning to see our efforts bear fruit. In fact, very recently, you may have noticed that there is a Thai beverage company which has put in an application to list on our exchange. And therefore, to your question, yes, we welcome companies, quality companies from around the world, wherever their origin. And, so long as they meet our requirements, we certainly will very much like to see them coming to list on our markets.
That goes back into the IPO question.
Yes.
Lots of talk about a very large mainland Chinese company looking to list here. Could be the biggest in 4 years. I know you can't comment specifically on names, but we know who we're talking about. Could you comment on that? Do we have a better understanding of when the timing of such big listing could come?
Okay. Yes, I am not able to talk about specific name, but suffice to say that in our pipeline, we do have quite a number of very, very big companies in terms of market cap. And I think the one that you're alluding to is probably over 1 trillion RMB in terms of market cap. So That, I believe, is another illustration of the depth, how deep our market is. And what I can share is that, it is only one example of a mega cap company which is sitting in our pipeline. There are more. And we do believe, and I think this has been demonstrated over and over again, the ability of our market to sustain, very ambitious fundraising activity. You've been obviously following us for a long time. We have over the years, been able to turn out, multiple billions of dollars of fundraising. So it's not a problem at all. Personally, I am very pleased to see that. By pedigree, I have done IPOs for many decades. So I think what we will do is to continue improving our listing regime to make sure that we're always fit for purpose. Because frankly, the newer types of companies, the newer vintage of companies, they may have different needs. They fit a different profile. And so our job is really to make sure that we continue to review our listing rules to make sure that we can cater for their needs most appropriately.
I need to ask you then about another big Middle Eastern company name that's always been tied to to here. We both know what we're talking about. Any update on that? You mentioned you have other mega cap companies in the pipeline.
Okay, well, like I said, our IPO pipeline is very transparent. You can go onto our website and you'll see who is
what's not there though is the timing.
However, I would say I continue to spend a lot of time in the Middle East. In fact, I have a trip coming up in 2 weeks' time. And then later in the month, end of May, is when we're hosting the Capital Markets Forum again, the Tadawul one, which we have obviously signed an MOU with. And so I would say that this engagement has further developed since we've signed that MOU. And I am pretty confident as we spend more time there, and of course, we are opening an office very soon in Riyadh. Hopefully, I will be able to share more exciting news with you in due course.
Okay, understood. Now, I need to ask you about short term. The last few weeks has been extremely volatile for markets. And I'm wondering, just a general consensus based on the people that you speak with, are people more conscious or cognizant over pushing back pipelines for listing over the short term because of what's going on? Is there a sense that people are just waiting for the dust to settle?
Well, first of all, I think the volatility is felt around the world. It's not specific to Hong Kong. But I would say even with all that volatility, and they are pretty dramatic, our market has demonstrated a lot of resilience. In fact, there was, this day when we experienced, quite a big correction. It was also the day that we've recorded record trading volume, and it was only a couple of weeks ago. However, I think probably a less noticed fact is that even amidst all this volatility, deals get done. We have in the past few weeks priced and successfully listed another handful of companies on our exchange, and the pipeline continues to build. So no signs of the appetite abating. In fact, quite the opposite. I think, given that we've demonstrated that resilience and we were able to trade through this period of heightened volatility in a very orderly manner, I think people are now beginning to really appreciate what Hong Kong and HKEX have to offer as a fundraising and a trading platform.
That was Bonnie Chan there, the CEO of HKEX, after they reported record revenue and also profits around this time yesterday. Now, if you're one of our subscribers and clients here, you can catch up on all the interviews you might have missed that, and we've had many others as well the last 24 hours or so. Scroll back, and also if you want to be part of the conversation, you know how to reach us on the IB chat. Check it out. The BOJ decision is likely to come over the next hour or so stay tuned. Plenty more ahead here on Bloomberg Television. Right, first day of May. What's that? 1971 Carole King hits. I feel the earth move, as mellow as the month of May. And it's really, when you look historically, it's not really been the best month for equity markets. Average returns over the last 30 years or so, only in the S&P. Now, on the S&P itself, overnight, here's a nice chart, reversing 2% intraday loss into the close. Now, that's happened about 32 times in the last, I would say, going back 30, 40 years. In 20 of those 32 times, actually, that it ended higher, the market then goes on to rally. It's not that reliable an indicator, but it's then gone on to rally about 2%. So just keep that in mind. Good morning. Welcome back. So a lot of markets are shut across the Asia Pacific. You only have, in fact, just less than a handful that are up and running, one of which is Japan, of course. You have treasuries, you have cash markets going into the break, and we're also in the window for a Bank of Japan decision. Should be out any time now. In fact, let's talk more about this. So Sherry Ahn, our co-anchor, is outside the Bank of Japan right now. And also joining us is Jesper, Koll, expert director at the Monex Group, to help us unpack the story and the longer-term outlook here for interest rates in Japan. Jesper, David here, just thank you for joining us, by the way. Why don't we start there? Because the expectations are that there's really nothing that's going to happen today, but is the door still open to normalize policy is what I want to get to.
I think the answer is yes. The Bank of Japan wants to be a bastion of stability. There's obviously so much going on with enormous, perhaps unprecedented global uncertainty. From that perspective, steady she goes. Governor Ueda has been very clear that as long as the economy keeps tracking the policy board's forecast, they're going to continue with the normalization process. There is no rush to do that. Obviously, economic data is going to be volatile, so they're going to stay on hold and be a bastion of stability.
Jesper, I think the Nikkei reported a few hours back that we might actually see a growth downgrade in terms of the forecasting. What do you feel the economy is doing at the moment?
Look, right now, the one thing that is happening is that consumer price inflation is running well above wages. And you've seen the last data set that actually shows that now that government support measures for utility and energy prices are being cut back, you actually find that Mr. and Mrs. Watanabe is hurting. Real wages are declining. So as a result of that, a modest downgrade of the GDP forecast by the policy board makes a lot of sense. It's what every private economist is doing as well.
But at the same time, of course, we have inflation accelerating. Do you expect this momentum to continue? Core national CPI above that 3% threshold for the last, 4 months or so?
Yeah. And Sherry, you put your finger on the pulse here. Clearly, demand pull inflation is starting to become more evident. You see that service sector prices, which have nothing to do with the exchange rate going up and down, have nothing to do with energy prices or exporter prices. It's domestic demand where corporate Japan is discovering, yes, we actually have price power. Consumers can take the price increases, and that, inflation pressure is something that we need to watch very carefully. Is it a smoking gun? At this particular point, in my opinion, it is not. It's not for the Bank of Japan to choke off aggregate demand, but is it a concern? I think the answer is absolutely yes.
In that sense, could traders be underpricing the moves in the Japanese yen? Because we are seeing a very crowded trade that we might continue to gain ground against the U.S. dollar. But at a time when the BOJ is holding, are we going to see more weakness if Governor Ueda surprises to the downside on his more dovish rhetoric?
So it's so interesting, right? Because look, and we all would have to agree, it's all about the dollar. It's all about what's going on in the United States with the tariffs, what's going on in the United States with the potential for recession, what's going on in the United States with the potential for Fed rate cuts coming sooner or later. That's what's going to dictate dollar yen here. at the margin, I think, what's happening in Japan, I don't want to use the word is irrelevant, but I don't think it's going to be the big trade that you're going to be betting for, because quite frankly, here in Japan, everybody's very pragmatic. The government, the negotiation team with Trump, Governor Ueda, incredibly confident that they've got the wherewithal to stand through whatever the tariff debates are going to be yielding, and no need to do anything dramatic on either monetary policy or on fiscal policy. So from that perspective, Japan standing as this bastion of stability, I think is a very good way to think about it.
Yeah, I think Jesper, to your point, when we look at, say, positioning in the currency markets, markets are overwhelmingly bullish on the Japanese currency. And I think the point I want to get to here, and I'm wondering what you think, is there a level at which the Japanese yen strengthens that it becomes actually counterproductive right now in terms of the reflation project there in Japan?
Yeah, and thank you, David. I mean, this is the key point. I mean, let's just look at the facts. The latest Tankan survey basically showed Japan's corporation pricing their exchange rate break-even points at somewhere around 147, 148. So I would say the pain point, when are we going to get massive downgrades to corporate earnings because of the exchange rate, would be the moment dollar yen consistently trades below 138, 137. That's the pain point when corporate earnings are going to have to be cut.
At least when it comes to the currency, we have heard now from both sides that the rate was not really talked about during the trade negotiations with the U.S. How much of a risk is this if it's actually on the table? We are headed towards that second round of talks.
Look, I mean, I think that the answer is it's not going to be on the table. I know everybody wants to talk about it, but, it's very, very clear when you talk to anybody in the White House, when you talk to anybody at the Japanese Ministry of Finance, that yes, there is monitoring, there is concern about potential volatility spikes, but, are we at a stage where we're going to get a complete about turn in U.S. policy? We want a weaker dollar. Everybody likes to talk about it because that's the way they are positioning. But when you actually look at the reality, when you talk to the people who actually do the negotiations, it's not on the table right now. It's about the tariffs. It's about specific items such as agriculture, such as energy, such as shipbuilding. Those are the items that are on the table. The exchange rate is something that I expect is going to become more important, in 2026, 2027, when we are going to see, sort of a greater movement towards global coordination, towards a Mar-a-Lago Accord, whatever you want to call it. But now is not the time. Now is the time for trade details.
Right. So Jesper, on that point then, this is a negotiation, as you point out. So if it's not the yen, so what is on the table then? What do you think Japan, and I hate to use the phrase, but what will Japan need to give up?
Look, it's very simple. I mean, Trump is, for all intents and purposes, is like very simple, and very focused on just getting the bilateral deficit down. So what does America export that Japan actually wants? Number one, agriculture product. Number two, energy. And number three, what Japan can give is actually facilitate investment in the United States to ensure that the American port facilities, that the American energy pipelines are actually being brought into the 21st century so that those American exports of agriculture and American exports of energy can actually start to reach Japan sooner rather than later.
Jesper, in this day of changing trade flows, that could potentially mean a fundamental shift in world trade dynamics, in geopolitics as well. Where does Japan fit in at a time when Washington tries to pressure partners to also restrict connections with China? I mean, these two economies are so important for Japan. If we do see a new era that really goes beyond even the Trump administration, how does Japan gain that competitive edge?
Look, I mean, Japan certainly doesn't want to choose. If you look at, forget about exports, let's look at what matters, which is corporate profits. And what you basically find is that about 33% of corporate profits for Japan, 33% of them come from the United States, and about 25% come from the People's Republic of China. So you do not want to choose between America and the People's Republic of China when it comes to doing business. And so I think from that perspective, what the Japan negotiating team is trying to do is just say, let's focus on the bilateral sovereign country Japan and sovereign country United States of America. That's the deal that needs to be made. If you guys, i.e. Trump, if you guys want a bigger deal that involves an alliance against the People's Republic of China, Japan is going to say no, thank you.
Jesper, how strong is Prime Minister Ishiba? How much political capital does he have, not only to negotiate with Washington, but also just to keep domestic Japanese people happy at a time when the cost of living continues to go up?
No, and Sherry, this is where it gets very interesting, and as well as I do that Japan is run by the elite bureaucracy. So Ishiba is an unpopular prime minister who doesn't have the ability, at least for now, to inspire the Japanese people. So, it's not the politicians who are leading, it's the bureaucrats, it's the technocrats who are leading. And, from that perspective, I think we get a very pragmatic deal rather than a deal that is actually far-reaching and earth-shattering. It's just going to be industry-specific, sector-specific, rather than a grand vision, because, quite frankly, and I hate to be so blunt, but Ishiba doesn't have that grand vision. Ishiba is struggling to survive the next week.
Okay, and on that positive note, Jesper, let's leave it there. Thank you, Jesper Koll, expert director there at Monex Group. And of course, Sherry An, of course, our co-anchor, is live for us out of the Bank of Japan. And once we do get, of course, the breaking news out of Japan, you can trust that we will be getting back to Sherry quicker than gossip. In the meantime, though, on your Bloomberg, TLI Vigo has started our blog, commentary, analysis, and context around this BOJ decision, which I would say is imminent, but could come, of course, well, we don't know, to be honest. Anyway, we'll see. This is Bloomberg. We'll be here. Welcome back. Some political stories that we're following from around the world right now. We'll start things off with China. And, well, China has expelled a top military official from its national parliament. Now, authorities did not provide a reason for Miao Hua's removal. He used to serve on China's top military body overseeing political loyalty and was suspended from duties last year while under investigation for graft. Now, a widespread corruption investigation has then led to the removal of over a dozen senior military figures since mid of 2023. Now, the U.S. is urging India and Pakistan to, well, work together to de-escalate tensions and avoid a potential clash. Now, that's after, of course, militants last week killed dozens of people in the Indian-controlled portion of the disputed Himalayan region of Kashmir. Now, U.S. Secretary of State Marco Rubio is urging both sides to maintain peace and security in South Asia. Relations have rapidly worsened after the attack, which India with India accusing Pakistan of involvement. Islamabad, though, has denied any links to the assault. Right. Elections are a big key theme, of course, this week, and the outcome of Australia's tight federal election on Saturday could be the next catalyst for local assets amid this global tariff standoff that we're trying to muddle ourselves through. Paul Allen joins us right now for a look at really what the possible outcomes could mean here for markets. And yet, Paul, talk to us about the specific assets that are perhaps most sensitive to the outcomes here.
Yeah, well, first off, you mentioned there the outcome could be tight, and that could have an implications for the market. At the moment, it's possible that the Prime Minister Anthony Albanese could get back with a majority. The path to victory a lot harder for the opposition Liberal National Coalition. So one of the most likely outcomes is minority government. That means there's going to be some horse trading needed if some of these parties require smaller parties to give them support. So there will be a price to pay for that support. FIG Securities sees that meaning wider deficits potentially, and that could see bond yields rising as well. But there are some areas of commonality between both parties. Both are promising tax relief to assist with cost of living issues, so that could benefit consumer stocks. So you'll be watching the likes of Kohl's, Woolworths, JB Hi-Fi. Both parties are also promising greater investments in Medicare, which is Australia's universal healthcare. So that could mean some stocks like Australian Clinical Labs, Integral Diagnostics, those sorts of stocks could see some support as well after the election.
Now, Paul, what about the housing situation there and the shortage? Both major parties have been making promises to be able to address that problem. How are markets looking at that and looking to perhaps trade around that story?
Yeah, well, that is a familiar pledge. It's one we hear every 3 years, and a solution to the housing problem in Australia never really seems to materialise. But for what it's worth, the Albanese government is proposing support for first home buyers, as pledging $10 billion to build 100,000 homes. The opposition, meanwhile, saying first home buyers could get mortgage repayments as a potential tax break. Should this happen, that could support a number of the large construction firms, Stockland, Mirvac, Lendlease as well. However, there's an enduring question around all of this in terms of how extra houses actually get constructed, because if you look around Sydney right now, you see construction cranes everywhere. There is a skilled labour shortage. The price of building materials is extremely high as well. And it's that sort of question which is causing problems around a key pledge from the Liberal Party as well to build nuclear reactors. I mean, not only is there not a lot of support for that idea, but there are construction issues there as well. The energy question's an interesting one also, because Australian energy stocks have been some of the worst performers this year. The Liberal Party supports more traditional energy sources such as gas. The Labor government would invest more heavily in renewables. So some of the names to look at there post-election would be Origin, AGL, Santos, Woodside, could all potentially move after the poll on Saturday.
Paul, thank you so much for a preview and the sort of different aspects to watch as far as markets go. Paul Allen in Sydney for us. In fact, just our coverage of the elections coming through here and the build-up continues tomorrow. In fact, just on that very theme here on housing, we'll discuss how the crisis is influencing voters here with the CEO of Metricon, that's Australia's largest home builder, plus former Labor strategist talks to us through the latest polling and whether the country may be headed for a minority government. That outcome, we'll try and measure that, of course, in terms of tail risks. That's coming through. Plenty more ahead. This is Bloomberg.
China is not behind.
Anybody who's ahead of you?
China's right behind us. I mean, we're very, very close. But remember, this is a long-term. This is an infinite race. There's no, in the world of life, there's no 2-minute end of the quarter. There's no such thing, and so we're going to compete for a long time.
There we go. A bit deep there from Jensen Huang, the Nvidia CEO, warning that China is, in fact, growing into quite a formidable tech rival against the U.S. Now, he also says that President Trump needs to change the so-called diffusion rules over the export of AI technology. Nvidia is currently banned from selling its most advanced chips to China, and he spoke with us in Washington as tech executives held a forum with U.S. lawmakers.
In order to produce $500 billion worth of AI infrastructure requires enormous amounts of investment from a lot of different partners. And so we've brought on shore many partners to help us do that. And we're going to have to build our own factories in order to do that.
What's your message and conversation going to be like today with the president when it comes to tariffs?
I'm going to count on the fact that the administration has a good plan. And from our perspective, we would like to have policies that support and help accelerate the development of artificial intelligence in this new industry.
Do you think they're going to have an edit of the diffusion rule that was under the Biden administration, basically placing all these different countries in different buckets?
Well, I'm not sure what the new diffusion rule is going to be, but whatever it happens to be, it really has to recognize that the world has changed fundamentally since the previous diffusion rule was released. We need to accelerate the diffusion of American AI technology around the world. And so the policies and the encouragement from the administration, it really needs to be behind that.
Yeah, there we go. That was the Nvidia boss, Jensen Huang, speaking with our colleague, of course, Anne-Marie Hordern over in Washington. Right. Okay. So, well, a couple of things here, right? So we're in the thick of earnings season. So I think we're about halfway through the U.S. earnings season. We're about to wrap up really the busiest earnings week for the Asia Pacific. We're waiting for some key data points as far as particularly the U.S. economy, right? So, we're coming off a GDP contraction, point number one. Point number two is we have the ISM numbers soft, but that's forward-looking. That's a survey. And, of course, the jobs report is coming through as well. Plus, we're working through a BOJ decision, which we're still waiting for. In fact, let's take it over now, just some context here and what we're watching out for. Sherry An, our Asia Trade co-anchor, is, in fact, outside the central bank's headquarters in Tokyo. Just give us, Sherry, give us some color. What are we watching out for specifically here?
I mean, we are watching for that policy rate, which is expected to be unchanged for a second meeting at 0.5%. All economists surveyed by Bloomberg expecting no change when it comes to the benchmark rate. But what we'll be watching is really the economic report, because it will be the inflation forecast, the language around growth, which will be key. We have heard from Governor Ueda already really pledge that he's keeping the trade uncertainties in mind when he makes these policy decisions. We already heard from the IMF warning the Bank of Japan to keep their policy flexible. Of course, we are still about to see the full impact of those trade tariffs coming from the Trump administration. So the inflation expectations, the wording around that is key. So far, when we heard the latest projection, the Bank of Japan expected to reach the price target by the second half of their 3-year outlook ending in 2027. We have seen the core national CPI has remained above that 3% growth rate in the past 4 months. The BOJ still thinks that underlying inflation is slightly below its 2% inflation target, but you can't deny that inflation, that the cost of living has been rising here across the country. Will be weighing also what they think about the Japanese yen as well, because it's appreciated this year about 9% year to date against the US dollar.
Right, Sherry An will be standing by for us outside the Bank of Japan over in Tokyo. They hiked rates 3 times last year. If they hold this meeting, that's a second straight hold. When you look at swaps moving forward here as far as the BOJ goes, we're not actually seeing a full hike priced at all this year, but that could all change depending on the context and the tone there coming through out of the BOJ. Right, before we wrap up shows here, just a very brief look at what we're watching out for. I alluded to this. It's extremely heavy on the U.S. eco front. Always is, but really a lot more weighting given how the uncertainty out there. In fact, going into, just a case in point, going into the GDP report which came out yesterday, we had the widest range of forecasts from economists there. In other words, we know nothing, but we also know maybe everything. Estimates for the jobs report coming through on Friday. Yep, so that's it from us here on the China Show. There's plenty more ahead, though, here on Bloomberg Television. Insights with Haslinda Amin is coming up next.